Good morning, everyone. My name is Apattanaik. I am an investment advisor at Sprott. The following excerpts are from a conversation I recorded with Rick Rule on the 23rd of August, 2022. Rick, I'd like to get your thoughts today on how volatility informs your views and your strategies as a speculator and an investor in the commodities sector. The market and the economy continue to be full of contradictions today. And I thought it would be useful for us to record your thoughts on how you have been navigating the volatility that we've seen in the commodities sector over the last few months, and also what a lot of macro prognosticators are forecasting lies ahead for this space. And I'd like to have this discussion in the context of three specific commodities, gold, silver, and uranium. So let me start this discussion with the topic of silver. Silver has turned out to be one of the worst performers over the last 2 years. It did move from $20 an ounce in 2019 to around $30 an ounce in 2020, but it has given all of that back now over the last 2 years. I was looking through the Q2 all-in sustaining costs numbers for a representative group of companies of primary silver producers, and the average consolidated AISC for that group was somewhere between $15 and $17 per ounce. Now, at $19, mining silver is not a very profitable business. So I would like to start this discussion with the dynamics that we've seen play out in the silver market over the last 2 years. We seem to be in a very financialized world right now because of monetary policies, which is driving an unnatural amount of volatility in everything, including essential commodities. It also seems to have condensed price cycles that are inherent in capital-intensive businesses. My question to you is, do you expect such condensed cycles to be the new norm in commodities in an economy which is clearly being manipulated by monetary policies and interest rates? And the second question is, using silver as an example, how do you plan as an investor to play the next leg up in the silver market, particularly in terms of an exit strategy, to avoid doing a similar round trip as we've seen play out from 2019 to the present day?
I guess there were two questions there. And the first one around what appears to be increasingly concentrated or short-term cycles. I think you have to look at two things. I think that you have to segregate between volatility and cyclicality, and natural resource markets expose you to both. If you have been around financial markets as long as 49 years now for me, you come to understand that resource-based markets are both cyclical and volatile. I suspect that the financialization of all asset classes that you describe probably over time increases volatility. There isn't much that happens in terms of financial markets that ultimately can change the nature of the cyclicality. But remember that these markets are capital intensive, very cyclical, and both the upside and the downside over time of price movements in natural resources is extreme relative to other classes. The volatility, I think, is partially a function of the financialization of markets, but I think it's also the function of rapidly converging big economic issues. I think it's important not to confuse volatility with cyclicality, which are very, very different things.
So, or as an investor or a speculator, how do you plan for an exit strategy given the volatility?
I don't think about them, to be honest, Aditya. I'm a position investor. meaning that I develop an outlook around a commodity that envisions as many long-term facts as I can gather. And I'm unlikely to change my strategy except in the face of extreme price movements. Extreme price movements down cause me to be a buyer. Extreme price movements up cause me to be a seller. Now, that might mean that I'm perpetually uncomfortable. It's difficult to buy when your thesis is being tested by declining prices. It's tough to sell, too, when the sell-side thesis is being contested by all kinds of bullish price action to the upside. But that's what you must do. My investment strategies are always guided by valuation strategies. And I regard volatility myself is at most a tool, which is to say, if the idea around investing is to buy low and sell high, occasionally volatility gives you the ability to do either in a much shorter time frame than would otherwise be the case. So I can be an opportunistic trader around volatility, but it doesn't really impact what I'm doing with a core position. If, as an example, I owned $1 million worth of silver equities, and the silver equities were to give me unexpected upside in the near term, it is not unlikely that I would sell 30 or 40% of my junior silver mining portfolio, the same way, Aditya, that you saw me a year or a year and a half ago deal with my junior uranium stocks in what was to me an unexpected uptick. Similarly, around my various commodity theses, I always try to develop a shopping list, which is to say companies that I'd like to own in varying circumstances. And to the extent that the performance of the commodity and the commodity-related equities is disappointing the markets in the near term, I'm much more inclined to be a buyer than a seller. It's important, I think, in this context to remember the old Wall Street ditty, stocks climb on a wall of worry, which is to say when the fundamentals are in place, but people aren't buying because the price action is bad, they're worrying about the price action, that's normally a fairly bullish situation. Stocks slide down the slope of hope, which is to say when people are hoping for higher prices, particularly when they're heartened around a thesis, you often are in for tough times. Considering the silver market, one needs to understand that it's an atypical commodity. In the first instance, it is partially a monetary metal. Silver has been used as a store of value and a medium of exchange in many, many cultures over a very long time. And in that case, many investors and speculators look at it as a monetary metal, as a lower priced, more liquid substitute for gold. By the way, more volatile too. Silver is also an industrial material. It's critical for things like water and wastewater treatment. It's critical as a reflective component of solar energy and other technologies like that. Some years, 1 billion ounces of silver gets used up in those activities. It's a strange commodity too, Aditya, in that primary silver mine production, which is to say mines where more than 50% of their revenue come from silver, generates between 18 and 20% of silver supply. So while silver is critical to silver mines themselves are much less critical to the supply of silver than recycling and in particular byproduct production from things like gold mines, copper mines, lead mines, and zinc mines. Because demand for silver is both monetary and industrial, it's difficult to gauge demand by traditional metrics. You have to figure in both. And because so much of the supply of silver comes about as a consequence of mining for other materials, looking at all-in sustaining costs around silver miners is less instructive than it might otherwise be. You have to understand the economics of copper mining and lead mining and zinc mining. and look at the unit production of silver that will occur as a consequence of mining other metals. The other thing about the silver market that's always fascinated me has been the role that the Indian subcontinent plays in silver. The Indian subcontinent has functioned for decades as a silver sink in ways that often baffle Western analysts who have less sense of what's happening in India than they might otherwise were they studying silver supply and demand. So I would suggest to you that silver is a commodity that is more difficult than most to develop valuation patterns around. The third thing, and I'm sorry for this long-winded answer, Aditya, but it's a very big question. The third thing that people need to remember about silver is that, at least in terms of its speculative component, that in the last two precious metals bull markets, silver has been more a late cycle mover than an early mover. It would appear that speculative demand, investor demand for silver, and when I say speculative demand, I'm talking about demand ex-Pakistan, Bangladesh, India, and Sri Lanka, which are special markets for silver. But speculative demand for silver in the West and the developed nations seems to occur after the momentum has already been established by gold. It would seem that the gold buyer is a fear buyer and the silver buyer is a greed buyer. So that once the fundamental trend in the direction of precious metals is up, gold moves first, but then silver moves further and faster.
There were a couple of things you said in there that stood out, and in my original question, I was trying to see if you quantify your exit strategy, because valuations will change depending on how high you think silver will go. So as an example, in 2019, silver prices were 20, in 2020, they were 30. So you can argue that the silver stocks were expensive in 2020, and so they should have sold off if your long-term price forecast was 20 or 25. So given the comment that you made about the market being difficult to quantify and almost irrational in a sense, how, as a disciplined investor, how do you apply the principles that you talk about regarding price and value in the silver market and silver stocks?
Every stock in my portfolio has a very rudimentary valuation calculation in my file, generally handwritten, generally no more than 2 pages of scribble. And part of the scribble, if I have a big enough position, involves net present value calculation, a very rough one, in a variety of pricing scenarios. In the case of silver, I'm currently running a $15 case, a $20 case, and a $30 case. Meaning that I try to quantify for a downside, for a stasis side, and for an upside. I also, in the case of silver, because it's so volatile, run myself a shadow $50 case, so that I can take into account, and I don't give it much credence in my valuation, but I can take into account the incredible benefits that one might accrue as a consequence of optionality. In other words, if the silver market really, really did something. Nowhere in my valuation do I do any sort of calculation around the impact of a narrative on a story. In other words, I don't account for boredom and I don't account for elation. What I'm trying to do in this circumstance is give myself a sort of a base case to invest and trade around, knowing that I won't be right ever, but knowing that I will be more right over time than most people who don't go through the effort.
The second topic is gold
Right.
in our call today. I I was reading through some of the older Berkshire Hathaway reports over the decade of the 70s, and I found one reference to gold made over that period in his letter to shareholders, which I think is worth bringing up today. The comment was made in his 1979 letter to shareholders and was interesting because he was discussing this in the context of how the management team had compounded the book value per share 20% per year since acquiring the firm in 1964. But in 1979, when he was talking about these returns, even a 20% return on shareholder equity did not equate to too much on a real return basis for an investor after taxes and inflation, were they to realize those gains in that year. The reference to gold in that letter was that the book value per share in 1964 was equal to half an ounce of gold, which was exactly the same in terms of book value per share in 1979, after compounding at 20% per year for 15 years. So gold at that time sounded like it was doing a job in terms of an inflation hedge and a store of value. Now, of course, we were in 1979 and gold was close to its all-time high, and it didn't do much for the next 20 years. And Buffett has since changed his view on gold and calls it a pet rock. And I think if he made a similar comparison with book value per share appreciation over the next 20 years, it would make his case for why gold might appear to have been a pet rock. We are living in a time, again, which feels a lot like the 70s in terms of high inflation, in terms of real returns being an issue. There are some big differences, of course, and you brought some of them up: demographics, technology, globalization, debt levels. They're all very different from the 70s. But when I think about gold today, what I find most interesting about the gold investment thesis today is that even though theoretically we are in an ideal environment where gold should shine as an asset class, I still see a debate going on about the efficacy of gold as an inflation hedge and about its direction from here on. I saw Goldman Sachs and Credit Suisse last week were downgrading their price targets for gold because they feel that the Fed is going to keep raising rates, and I find that quite strange. So high inflation in itself has not driven institutional investment demand into gold. My question to you is, having seen two cycles in gold now, one in the 70s and one in the 2000s, what surprises you the most about this cycle today?
I'm surprised that gold has taken so long to catch a bid, but I was surprised too in the early part of the decade of the 70s. Remember, Aditya, that people's anticipation of the future is set by their experience in the immediate past. And I think that individual institutional perceptions are consistent. In the late part of the 60s, the writing was on the wall with regards to inflation, with regards to the diminution of purchasing power associated with savings, at least if those savings were in debt instruments. But people's expectation of the future was set by their experience in the late 40s, the 50s, and the 60s, which is to say they'd been through 20 years of pretty good economic times. And the fact that they saw inflation in the period 1968 to 1972, what they saw in terms of inflation was troubling, but it wasn't terrifying, which is to say, yes, the price of gasoline went up. Yes, the price of bread went up. Wages went up too, but wages didn't go up as fast as inflation. I like to say that people regard inflation as an annoyance when the price of gas at the pump goes up, and they regard it seriously when they can no longer afford a car. Inflation is cumulative and compounding, and people have been trained to think in 3-month or 12 months increments. My suspicion is that if inflation continues at its current rate, or even at a lower but still historically high rate given the last 40 years, that concern about inflation will once again occupy people's mind. In the very, very near term, Aditya, and I use the 12-month time frame to describe the very near term, I see two factors. One, the denomination of most of the world's debt in dollars, and as a consequence, ongoing demand for dollars in global credit markets, and the relative strength of the US dollar, which may allow the Fed to continue to raise interest rates for a while, as being positive for the dollar, and as a consequence, troubling for US dollar denominated holders of gold. It's very important for you and the audience to understand, Aditya, if you're holding gold in euros or in yen or in renminbi or in rupiah, gold's done its job. If you're holding gold in US dollars, it's been a bit more challenging. But I'll reinforce, too, that things change very, very quickly. Prices do, in fact, climb a wall of worry. When you have a circumstance around you, which is to say negative real interest rates on savings products denominated in US dollars, a saver can be willing and able to afford the diminution of purchasing power on their savings for a year or 2 years or 3 years. Similarly, a very large institutional investor with 40% of his or her portfolio in long-term debt instruments can afford to ignore the deterioration of the corpus of that pension fund relative to the obligations that it will need to fund 20 or 25 years from now for a year or 2 years or 3 years. But at some point in time, you have a break in confidence. And I don't see that break in confidence having occurred yet.
It's interesting to watch it from this side of the fence as a gold investor. It seemed like all of this was inevitable. Jerome Powell recently said that there's a lot about inflation that they don't understand. I find it very funny that everybody believes that it's fixable by the same people that didn't see it coming. For me, it seems a bit odd, and it seems overly simplistic as an explanation for why this asset class has not done what I and a lot of our clients that I speak to on a regular basis thought it was supposed to do. And that's why I've asked you this question before. And I was curious, having seen several cycles, I wonder whether your tolerance for surprises is different, or time frames is different, or whether you feel it's something has changed.
As I've gotten older, as I've been through more cycles, I certainly have become much more realistic with regards to the timeframes I expect. I've told you before, Aditya, when I was a young man and I had lots of time left on Earth, I was strangely impatient. And I've told you, too, that I suffered from a very lineal thinking mentality, which is to say, if A is true and B is true and C is true and D is true, and if the logical outcome of that is something, I confused when I was young 2 words in English, inevitable and imminent. As I experienced more cycles myself, and as I learned the difference between those words, I developed a new mantra, which is to say, when I asked myself a question where the answer was much more likely than not to begin with the word when and not if, then I was asking myself a high quality question. And I certainly believe that to be the case in natural resource investing generally and precious metals investing too. There have been other points in time in my career when I have misinterpreted the fact that a circumstance had to occur with the fact that it should occur quickly. An example would be natural gas markets in the 1980s as a consequence of very strong price performance and hence very strong investment in the oil and gas sector. The decontrolled natural gas prices in the United States fell from about $15 per million BTU to about $1 per million BTUs. And the consequence of that is that capital investment in natural gas exploration in the United States fell like a boulder off a bridge. Beginning in about 1987 or 1988, I believed that U.S. natural gas prices had to rise. And they did, but they didn't for 4 years. What we thought was a gas bubble in 1983 turned into a gas sausage, where domestic gas, was priced at a discount to the incentive price for new productions for almost a decade. Similarly, the price of zinc stayed below the global cost of production for 6 or 7 years. And famously, of course, the uranium price in the period, for a very long time, but certainly for 4 years after I identified it as an investment theme, the price of uranium stayed depressed for 4 years until 2002, where it began to take off like an absolute rocket. So I suggest to you that understanding cyclicality in natural resources and also understanding the very long time involved in cycles, that the thing that's changed with me has been my tolerance for long time frames. If my certainty about the investment thesis, the economics around the investment thesis, not the narrative, remains intact.
It's a very interesting point, and this is a discussion I have with a lot of people about time frames. Did you get anything wrong in your thesis itself, which led you to be 3 or 4 years early, or was it unknown events which occurred after that delayed the inevitable?
With regards to being early in the uranium space, probably what I didn't understand is the willingness of large investors to run the world's energy economy at that point in time on more expensive fuels, rather than spend the capital that would have been required to increase the utilization in the near term of nuclear power. But it's worth noting that in both cases, while I was wrong in the short term, the arithmetic was inescapable in the longer term. I used to joke that if you were 4 years early on an investment theme, at a 10% cost of funds, which is the way I used to discount in those days, you weren't early. You were in fact wrong. But what happened was that the rents that I got paid when those markets eventually turned, even at that high interest rate, was such that I overcame the time value of money very, very, very handily. The psychological damage that was done is still painful to remember.
I'd like to end this call with a brief discussion on uranium. The medium to long-term investment case here continues to gather momentum, especially given the chaos in the natural gas markets right now with the situation in Russia. The stocks seem to have a mind of their own and have been extremely volatile over the last year and continue to be extremely volatile. The question that I want to ask you is, again, for investors that are thinking about this as an investment, as a longer term investment, how would you recommend people think about an exit strategy in the uranium sector today, given where we are right now and given various catalysts that have taken place on the demand side over the last year and various catalysts that are ahead on the supply side from mines that have been mothballed and are going to come back online? What would constitute a situation where uranium stocks are ahead of themselves for you going forward?
I think that I think we use the wrong phrase when we talk about uranium stocks as a monolith. If there are 75 uranium juniors worldwide, there isn't a junior uranium market, at least not one that makes sense. In that universe of 75 companies, there are probably 12 worth speculating on. So the first thing that one does is one examines the underlying thesis about uranium. There are, in my view, two principal risks. One would be a replay of Chernobyl or 3 Mile Island, which is to say a power plant catastrophe. And the proper response to that is the second you hear about it, you sell your uranium stocks. Because the narrative around the stock and the narrative around power from that commodity gets destroyed for some period of time. The second is the specter of a very deep and very broad recession or depression, which would lower demand for electricity and raise the capital cost of new power plant construction. If you can see yourself clear to coping with the possibility of catastrophic loss as a consequence of Chernobyl or 3 Mile Island, and if you believe that even if we suffer a recession, it will be relative to some prior recessions less severe and of less duration, there really isn't an excuse not to be in the uranium market today. The fact that uranium is going to go up doesn't necessarily mean that companies that are merely looking for uranium or own uranium that would take very, very, very high uranium prices to put in production, it doesn't mean that those companies will prosper. They may go up in price in the sense that a rising tide floats all ships. But I think it's important in any exercise, in any commodity, to align your portfolio with the risks that you can take, the time frames that it will take, for you to achieve, that type of thing. And I think that your stock selection necessarily reflects more than just the uranium price. Certainly mine does. You will recall, Aditya, that in 2014, 2015, I moved back into the uranium junior space with some enthusiasm, given how cheap the stocks had become. And once again, I was fairly early. I confused inevitable with imminent. But when we had that sort of boomlet market years ago, the uranium juniors went up so far, so fast in price. By the way, the worst ones outpaced the best ones in terms of their price performance. I turned from being a buyer to being a bystander to being a seller, simply because the market capitalizations that these companies achieved exceeded by a wide margin my expectation of their net present value. A technical trader would have hung on longer than I did, but my work was more valuation based than momentum based. Now we have the circumstance where some of the companies are substantially more advanced than they were then. at the same time that the time frames associated with higher uranium prices have come closer. So on a discounted net present value basis, the 3 or 4 years that I was afraid of have been used up. The 3 or 4 years is gone. So it's difficult for me to understand why a speculator wouldn't be attracted to the uranium juniors, except that people's expectation of the future is set by their experience in the immediate past. And in the immediate past, they've lost 50 or 60% on their uranium stocks. To them, this is discouraging. They don't seem to take into account the fact that arithmetically, a stock that's fallen by 50% in price is precisely twice as attractive as it was before it fell in price. The other side of that, of course, Aditya, is that a stock that's down by 90% is a stock that used to be down by 80% and then fell by half.